All right, well, welcome everyone, and thanks for taking the time out of your day to jump on this webinar with us. This webinar is going to teach everyone about the current energy market and how our company can help you. If you do have any questions throughout the presentation, put them in the questions tab and we will answer them at the end of the presentation. There will also be prizes rewarded at the end of the presentation, so if you stay, you could hopefully win a prize. Next slide, please. So our speakers today are Keith Finnucan, the CEO here at Eric Ryan Corporation, Chris Clark, the VP of the Energy Procurement Services at Eric Ryan, and then our guest speaker today is Ryan Finnucan, Business Development Manager at APG&E. And then just an outline of what we're going to go through today. The Eric Ryan history, we're going to do the summary of our clients, services currently offered here at Eric Ryan, natural gas storage, natural gas history, annual prices, market drivers, weather influences and prices, supplier value added services, average timelines, and then we'll do a quick summary at the end. If anyone has questions, that's when it would be to ask those questions. And then now I want to introduce our CEO and founder, Keith Finnucan. Keith, thanks for jumping on the call today.
Yeah, thank you, Melissa, and thank you everybody for attending. I see we have a nice blend of attendees out there today. We have not only some Eric Ryan existing customers, but customers that have used us off and on in the past for their energy purchasing needs, as well as some new names out there. So thank you all for coming on. The presentation should run 30 to 40 minutes, depending on how things go here. So next slide, if you would, please. The thing I like to do is just talk a little bit about our history, just for those newcomers that don't know much about us. But just real quick, we've been around 32 years now. We're based just north of Pittsburgh, Pennsylvania, and we incorporated in 1995. Eric and Ryan are my two sons. We currently are one of the largest in the country that does utility and telecommunications consulting. We now have 125 employees, and you can see we're all over, not only just in the United States, but outside the US and Canada. A couple of years ago, we made Pittsburgh's top 100 fastest growing, and a few years back from that, we made Inc. Magazine's top 500. So just a little bit of information about Eric Ryan. Next slide, please. Just so you know that we are a formidable player out there. These are some of the clients that we currently represent in some form or another, whether it's utility, telecommunications, both, whether it's energy buying. And a lot of these customers have been around for many, many years. We've had Costco stores for probably 10 plus years now. So you can see that there's quite a mix of customers that we do work with. Next slide, please. And then as far as services, I know our focus today is going to be on energy buying or energy procurement and the market. And the intent really is not so much to sell you about Eric Ryan, as much as just to give you information on where the market is, what our thoughts are on it, and what we see happening down the road here. But just so you know, we're in just about every space of the utility and telecommunications industry. So if there's something you need outside of energy buying and it's in the utility and telecom world, please feel free to reach out to us. We do everything from bill auditing to energy buying to pricing telecommunication services to sustainability reporting, which is becoming very, very big. Next slide, please. Melissa or Kendall. Okay, so what we'd like to do, we'd like to ask a multiple choice question here. If you wouldn't mind taking a minute to fill out one of your selections. This helps us to focus a little more on how we should present the actual webinar to you today. So if you would take a minute to fill this questionnaire in, please. We'll give it about a minute. Is that right, Melissa?
Yeah, most people have answered. So honestly, maybe 5 more seconds, because it looks like almost everyone has answered. And then I'll launch the poll for you. And then we could see what everyone has voted on and what we need to talk about.
Okay, thank you.
All right, and here are the results.
Okay, so thank you for sharing. It's good to know that You know, a lot of you are not in the business of waiting and doing nothing. There is time to act now. And so we will address, you know, based on the poll, Chris Clark will take time to kind of talk a little bit about things in the market. Next slide, please. Next slide. Okay, so with that, what I'd like to do is introduce our speaker, one of our speakers, Chris Clark. Chris has actually been with the Eric Ryan Corporation for 17 years, and he's actually built a very nice portfolio of customers or clients that we've been buying business for many, many, many years. We, you know, buy a lot of electricity in the millions of kilowatt hours a year, as well as in natural gas, millions of decatherms every year. He and his staff, you know, we do have a team that does energy buying, energy research, and they have 50+ years experience. And you can see the numbers here, you know, 457 billion kilowatt hours and 1.5 million decatherms of gas. So, you know, in the past years, we have serviced over 500 customers and have saved many, many millions of dollars to our clients. So with that being said, I want to turn it over to Chris Clark now to begin the webinar. Chris?
Thanks, Keith, and for everybody joining, and Melissa for hosting. So if you want to move to the next slide, I'll go ahead and get started here. So this first slide is just, I'm not going to spend a lot of time on it. This is a map that I actually put together quite a few years ago, just to give a high-level overview of energy deregulation in the United States. And, you know, really I chose to make my own map because natural gas, as many of you probably know on the call, is really open everywhere, but there's a lot of limitations in different states and even by different utilities within different markets. But this map just is, again, a primary sort of high-level focus on where a lot of energy deregulation happens, which of course is predominantly in the mid-Atlantic, the Northeast, and then of course Texas is a big market for especially electricity, and then we get into parts of Illinois and some limited programs out west. So if you want to go to the next slide. And I took this about a week ago. Many of you are probably aware the natural gas storage report is really a benchmark that comes out weekly on Thursday mornings at 10:30 Eastern Time. And really all that shows is just where we were compared to a year ago and where we are in comparison to what they call a 5-year average for natural gas underground storage. And that really is one of the key market drivers or benchmarks every week that the market uses to move the needle, meaning pricing up or down, depending on where storage levels are. I'm sure it's no secret. I'm sure many attendees today have already been on a lot of other webinars this year regarding energy, and natural gas is at quite a bit of a supply deficit we've been experiencing for the better part of the past year. So if you want to go to the next slide. And this is, I have two charts on natural gas prices. This first one is just a line graph, and I think this is a really good representation, the orange line being this current year in 2022, where natural gas prices are in comparison to the prior 3 years. So, you know, for the better part of the past decade, we've enjoyed prices that were $2, $3, even below $2 per decatherm at the wholesale price level. And of course, within the last few weeks, it was pushing $10 per decatherm with many utility rates, meaning when you do not have a contract with a third-party supplier, a lot of those utility default rates we're starting to see trickle in for the months of June and July, anywhere between $10 and $12 per decatherm. So if you don't have a contract and you're in a market that has one of those high rates, it's going to be awfully expensive. If you want to go to the next slide, please. And this is obviously just the numbers going back to 2014 of what I was just referencing, where natural gas prices were in the height of the shale boom that we experienced predominantly in the mid-Atlantic and again up into New England and the Northeast, where, you know, natural gas prices sunk to historically low levels, and many customers and utilities alike enjoyed, you know, buying at these low price points. And there's still a lot of clients that are locked in. Maybe some of you were locked in 2 or 3 years ago and you're coming off contract now, and of course seeing quite a bit of sticker shock. The interesting thing that we're going to mention today based on the poll, it's very helpful, is, you know, these prices have surged to such a high level. You know, what do we do if you're coming off agreement? So if we can go to the next couple of slides here, we'll talk about some of the bullish market drivers. The big one that I think most people are aware of by now is we're exporting more natural gas out of the United States than we ever have before. And the acronym is LNG, which stands for liquefied natural gas. And we're sending record imports of this stuff into Europe. That coupled with the sluggish natural gas production, really what's going on, I try to attend a lot of informational webinars from other suppliers and consultants throughout our industry. And I have to agree with some of the folks that are saying that, the producers were not really making any money at these previous price levels, $2 wholesale, $3 wholesale. And despite the demand for natural gas increasing for both LNG and domestically in the United States for primarily electric power generation, what's happening is, we really feel that production has sort of had a lid on it or being kept down for now until some of these investors in natural gas production really start to recoup some of their investments. Hopefully what will happen is the production will increase and we'll start to see prices stabilize. Likely not back down to the $2 and $3 levels we've enjoyed, but hopefully nowhere near $9 or $10 per decatherm either. And I attended another webinar and tend to follow a gentleman named Stephen Shork. He puts out a market report, and he'll attend webinars and give presentations throughout our industry with various suppliers and consultants. And I always really enjoy listening to him. And one of the key points I think that he hit on that I don't see a whole lot in reports is that, really the European Union made a big push to switch away from coal. And they achieved that, but it pushed them into natural gas. So while there's a lot of commentary out there about the war in Ukraine with Russia, that certainly plays a role into this because Russia, as most people know, supplied a lot of natural gas to Europe. But really, there's a little more to the story, I believe, where just moving away from coal in general, pushed into natural gas, which placed a global demand on natural gas, where domestically natural gas was traded as a domestic product in the United States primarily. And now we're really seeing the effects of global pricing where these other countries play considerably more for natural gas. And then the last bullet on this slide real quick is that the Federal Energy Information Administration, they're the ones that put out that weekly natural gas storage report. They expect in their latest short-term energy outlook for our natural gas inventories in the United States to be about 9% below the 5-year average at the end of our injection season. So over summer, theoretically, we inject gas into underground storage in anticipation of the upcoming winter. And we've been hovering around a 13 to 17% supply deficit as we look back over the last several weeks and months. So it looks like we're going to hover just around 9% a deficit as we get into the end of injection season. So if we can go to the next slide. And then we like to always end some comments that, in energy, the weather sort of overrides or trumps all. I'm sure most attendees today remember just in February 21, our most recent major weather event that primarily hit Texas and just caused power prices to surge to unbelievable levels. Prior to that, the polar vortex that occurred in 2014 is another memorable weather event that sort of just disrupted the whole energy market. So again, supply, demand, global things, there's a whole laundry list of drivers in the energy market. But when we have a major weather event, that sort of overrides anything. What's really interesting to me about my time in the business is I got started right after Hurricanes Katrina and Rita in January 2006 is when I started. And, it used to be that every year hurricane season would come onto the calendars around June and then last all summer and into the fall. And what's really fascinating and a bit of good information to share is that hurricanes really no longer play the role that they used to, mostly because we make so much natural gas onshore that any disruption to offshore production barely makes a dent in our pricing. So I thought that was worth mentioning. If we can go to the next slide, please. So another thing that our guest speaker, Ryan Finnucan, and I wanted to cover was, you do a lot of webinars and hear a lot of news about how bad prices are, but I thought it would be good to share some insight into what goes on behind the scenes with a consultant like Eric Ryan, and when we work with suppliers like APG&E and our other partners, what goes on behind the scenes to get bids. We get a lot of clients that come into the door at Eric Ryan and, their contract might be expiring sometimes within a few days of them becoming a client here. And it creates some challenges because utilities have enrollment deadlines, meaning that if we are going to sign a contract, it has to be done anywhere from about 10 to 30 days in advance of your meter read. We also have to contend with, if you have an existing agreement, what the auto renewal language, if any, is in that agreement, how long we have to maybe notify your current supplier of your intent to change or drop them, or whatever the case may be. So I wanted to give some background into some of the expectations when working with a consultant, or even if you work directly with suppliers, what they're doing behind the scenes. So if we can go to the next slide. When we start our bid process here, so when we get invoices in-house and make account lists and get copies of current contracts, utilities legally have several days in just about every market. And Ryan's going to expand on this a little bit with some examples, but the process in general takes about a week from start to finish, meaning when we get all the information we need and we send out an RFP to get pricing for a client, we have to give the suppliers about a week because the utilities need a couple days to turn around data. Suppliers need a couple of days to run credit on a given client and just get everything loaded into their systems. Obviously, if you're a larger end user that has hundreds of accounts, this process could easily be doubled to about a 2-week timeline. And then, of course, in light of recent, conditions out there economically and so forth, everybody's under some crunch time, whether it be with staffing needs or the fact that the energy market has just been so crazy volatile that suppliers are having some difficulty keeping up with pricing requests and so forth, especially if we have a day where the market goes down. So once we get pricing back, it's really on the consultant to analyze the bids, put them in an apples to apples format that's easy to digest and share with our clients, and then make a recommendation. And then once we make the recommendation, we really, especially now more than ever, recommend that our clients focus on a term length, and if you need to have legal review of any contracts in advance of signing an agreement, we and a lot of other reputable consultants will vet all of the suppliers that we work with and their contracts. I'm sure a lot of people on this call do energy agreements already and know that there's not a whole lot of wiggle room in these agreements for negotiation. Typically, we see contracts that are negotiated for choice of law or payment terms. Outside of that, there's typically not a whole lot of adjustment that we see in terms of changing contract language. But focusing on the term length and reviewing those agreements in advance will just ensure that the suppliers can help us expedite the process. And I can't stress enough, now more than ever, with the volatility in the market, I think any reputable consultant or supplier would tell a customer the most important thing that you can do for yourself and your business right now is just be ready. If we go get pricing and the numbers are ugly, that's more than reasonable. If people want to wait things out a bit, if they think we might go into a recession, which is a lot of commentary out there, and I tend to believe that if we hit a recession environment, these energy prices will go down. So we saw from the poll there was quite a few people that talked about locking just 50%. We're certainly seeing a lot of clients feel that way, where they're a bit apprehensive to lock all in, especially for 2 or 3 years, even though those prices look better. It's an awfully long commitment to make should prices fall. So I think the key takeaway there is just be ready. That way, if we see a large drop in gas prices or power prices, if they go down 20, 30% in a given day like they did roughly a week ago, you can be ready to strike if a desired target price is hit. So if we can go on the next slide, please. And I always like to mention, really in the last few years, many suppliers are now offering some value-added services. So beyond just a typical energy agreement that gives you a fixed price or a variable price or a hybrid of the two, a lot of these energy suppliers that we partner with are offering financial incentives to do various energy projects or reduce consumption. They might give things as simple as notifications, such as it's going to be 95 degrees and humid and hot in the Northeast. You might want to do anything you can to scale back operations to reduce consumption. And of course, they have more robust programs that can do demand response or even finance projects for lighting, HVAC, things like that. And a lot of suppliers will put these programs onto your monthly energy supply invoice. So it just streamlines securing financing, and really the whole entire process. And again, somebody like Eric Ryan would be able to vet whether or not, entering a program like that is a good fit for your needs, or maybe you need to keep the two things separate, meaning if you're doing an energy project, maybe you need to keep your contract separate from that. So if we can go on the next slide. And I think we're going to turn this over to Ryan, and he can expand a little bit more on some of the timelines with the utility. So Ryan, take it away.
Thank you, Chris, and thank you, Eric Ryan, for inviting me onto this call to speak with everybody. I've been very lucky in my career. The past 12 years, I have an opportunity to work with Eric Ryan, and it's something that as a supplier, you hope to be able to have a partner like this. So thank you. I'm going to talk about one just small part of the whole process of how we build a rate for a customer. That is a EDI transaction, electric data interchange. How that happens is Eric Ryan will send the supplier an RFP with the bill with the account numbers. And then what we have to do then is reach out to the utility and get that information. So there's certain things in that interchange that we need, like capacity values, transmission values, all those things are needed in order for us to help build a rate. Each utility is going to require a different amount of days to return that EDI information. And furthermore, depending on what type of monthly meter you are, either monthly or interval, that can elongate how long it takes for us to get that information back. Next slide, please. So right here, I'm talking about the Ohio utilities, highlighting the First Energy, AEP, and Dayton Power and Light. Within the First Energy utilities, you have Ohio Edison, the Illuminating Company, and Toledo Edison. On average, it takes about 1 to 2 days to get that information back. From the initial request from a supplier to the utility, that's about the number of days it takes for them to get that information. AEP, Columbus Southern, and Ohio Power can take anywhere from 1 to 3 days. Dayton Power and Light, on average, is about 2 days. Another utility that I don't have listed here, Duke. Duke, depending on whether you're monthly or interval, can take longer. Monthly requests are quicker, but interval can take, I've seen it take a few days. 3 days maybe. Next slide, please. Pennsylvania, we also have First Energy, which is Metropolitan Edison, Pennsylvania Electric Company, Pennsylvania Power Company, and West Penn Power. That averages about the same timeline as it does in Ohio, which is 1 to 2 days. PP&L is 1 to 2 days as well, but now that's just for monthly. Interval can take up to a week. Duquesne Power and Light takes about 2 to 3 days. And I should say that all this is precedented on everything being perfect. So we have to have the correct account number. If there's a digit that's off in that account number, we have to restart, and we won't know until they reject the EDI request, which is, it's unfortunate when that happens, but sometimes it happens a lot, especially if you have a lot of accounts in the RFP. Next slide.
Okay, so the next poll I'm going to share with you. So what type of contract are you currently operating under is the question. And I'll give you a minute or so to answer this question, and then I'll show everyone the results. All right, 10 more seconds. Looks like most people have voted. All right. And here are the results.
Okay, well, it looks like a lot of people are set with fixed or blended, and some are even on tariff. Chris, Ryan, you want to weigh in on thoughts here? It looks like those that are fixed may be in a good position unless they just recently locked the price. I was surprised to see nobody's floating the market now, but anybody want to weigh in on the poll here?
Yeah, sure, Keith. This is Chris. I can take that question, and then if Ryan wants to share some comments, that'd be great too. But, I think what we're seeing a lot of is, clients coming off of agreements that were locked in a year or longer ago. And again, of course, seeing a lot of sticker shock with these current agreements. And we're also getting a lot of feedback and even making a lot of recommendations where locking in the near term, meaning really anything that starts now or even in calendar 22 that goes for a year, we're really blending in a lot of high-priced, expensive months. So we're kind of in an awkward place where, if clients are comfortable locking into a 2 or 3 year agreement, or maybe doing a blended agreement where you lock a percentage of your load, maybe 50% or 25% or really any percent you choose, that's a way to navigate these high-priced current months. We're even doing some more radical things where we have some clients locking that begin, say, April of 23 or May of 23, when we see a sharp decline in natural gas prices from their current levels. Currently gas prices up until a week or so ago were $8, $9 for the balance of this year. Now they're down to roughly $6.75 to $7. But when we look out starting May of 23, prices go down to between $4 and $5. And it's a pretty significant delta. Suggests something is going on in the market. And the trouble always is, what do you do between now and then? And I think that's where a lot of blended agreements, or even in some situations, Keith, clients are going back to their local utility tariff just to bide some time if they can stomach a little bit of pain on the front end.
Okay, thank you. Ryan, anything you want to weigh in on there?
Yeah, I would say that if you're going to go back to the utility, do it short term. You definitely want to lock in something before winter comes around. That's when there's going to be some volatility that could get really painful.
Yeah.
Okay, thank you. All right, Melissa, what's the next slide? Okay, yeah. Do we have any questions out there, Melissa?
We don't have any as of now. So if anyone does want to ask a question, put that in the questions tab now so we can get those questions or answers for you.
Okay, we'll give it a couple of minutes. Chris, I know a lot of times that the company's risk tolerance has a big play in it. It's one thing that you have the market volatility. There's some clients, as you know, in the past, don't have a very high risk tolerance, like school districts and certain businesses. But how does that factor in right now? I guess with the market the way it is. Any thoughts on that?
Yeah, that's an excellent question, Keith. And, at Eric Ryan, we do have a lot of clients that are very budget driven. So, again, I think, unfortunately, the only way to dodge a really, really high fixed price is you're going to have to be willing to extend out 18 to 24 months and beyond just to try to keep the price down. Keith, one creative thing that we often see suppliers and consultants do, and there's even some suppliers that are putting this in writing and taking it a step further, is if you're somebody that's very budget driven, doesn't, have a lot of room for risk, of course, you're seeing higher prices. Maybe you're coming off a low priced agreement from the past few years. We're finding a good compromise to be somewhere in like the 18 to 24 month term. And where we're going to take that a step further, Keith, is a lot of suppliers, if the market really goes down, suppliers will offer something called a blend and extend. And in short, what that means is, let's just pretend a customer starts a 24-month agreement in July of this year. So that would go through June or July meter read date in 2024. And let's pretend that 1 year from now, prices drop by 50%. We're really lucky the market goes way down. And then, a client sitting there going, well, geez, I locked in July of 22, the price was at an all-time high. Now I'm stuck. What we can do, and what a lot of suppliers will do, is unwind the current contract, meaning they'll give you a lower price effective immediately in exchange for an extension to your term. Yeah. So if that makes sense, what we see happen there is that 2-year, 18-month, 2-year time frame is a healthy compromise between not paying a really high price associated with the near-term months, but giving yourself some flexibility that should prices fall, hopefully your supplier would reach out or your consultant could help negotiate a lower price via a blend and extend.
Thank you. Melissa?
Yeah, we don't have any questions, but I just want to let everyone know that, we do have a question actually. Sorry, just came in. Okay, do we expect rates to go back up when the Freeport LNG
like
facility
maybe we have
comes
some
back
questions
online?
there. Melissa?
Can you hear me? No.
Yeah, I can hear you, Melissa.
You can? Okay. All right, I'll read it again. It says, do we expect rates to go back up when the Freeport LNG facility comes back online?
Chris, you still there? Hmm.
It might be Keith. It might be people in the office because
Yep.
Kendall just said her connection was lost.
Yeah, mine was lost too. I'm back on.
Okay, I'll read it one more time. Okay. Do we expect rates to go back up when the Freeport LNG facility comes back online?
Yeah, I think that's a terrific question. And yes, I agree that Freeport, for those that may not be aware, there was a fire at a major natural gas, liquefied natural gas processing plant. And as a result, the market dropped about 20% within the past couple of weeks, which has been some relief, especially for clients needing to lock something in now. The original projection was the facility was going to come back online fairly quickly, and then there was an announcement made that it's not going to come back online till later this year. So when that happens, we're probably going to be right on the brink of winter. So I would say yes, there's a high probability, and I was going to get Ryan's opinion on this if he still has audio, but I would say yes, there's a high probability that when that facility comes back online, if storage levels are where the EIA expects, meaning 9-10% below the historical benchmarks or that 5-year average, we're probably going to be in for a bumpy ride where prices do go back up. I would say in closing with that, unless there's more of a major recession environment or something else going on where maybe summer gives us some relief to power burn, we're probably going to be looking at some volatility. Ryan, do you have anything to add on that?
I couldn't agree more. I think I appreciate it, nail on the head there, that winter's it could be a perfect storm for high rates. I mean, before this closure, I expected rates to get into the 10-cent range. So it was, a blessing, I guess, in the short term, but could be very, very dangerous in the winter.
Yeah, makes sense.
Ryan, Chris, if I may, this is Keith. I get asked this a lot. Why does tariff lag behind the market? I mean, what are the utilities buying, hedging? How's that work?
Yeah, that's a terrific question, Keith. So, what Keith's referring to is if you do not have a contract with a third-party supplier, you might still be paying reasonably or relatively low price compared to these, $9, $10, $12 decatherm gas prices or, 15 cent per kilowatt hour electric prices. But what's happening behind the scenes, and every utility is a little bit different. Of course, some do it a little bit better than others. But basically what happens is at a very high level in general across the United States, the utility rates tend to lag the market by about 3 months. And in short, the reason for that is the utilities are out there buying now. Typically, they do buy a little bit in advance. So it's taking them about 90 to 120 days to catch up to whatever the market's doing now. So now that we're seeing, I was just looking at some invoices today in California. The utility rates were, for natural gas were increasing from about $7 a decatherm, and I believe it was just shy of $12 per decatherm, where, a month ago, roughly at the wholesale level, natural gas prices were about $9. So those utilities that were buying at that highest price point a couple of months ago, by the time they add in additional costs to move that gas on the various systems and pipelines, and really the same thoughts apply to electric power, it's going to catch up to whatever the market's doing. The good news, real quick, is that since we have seen this drop off, any utilities that needed to procure supplies now, when prices went from $9 back down to $6, hopefully that's going to show some relief to attendees that might not have a contract or are floating out there on some sort of variable agreement. You might see some relief again in the near term.
Okay, thank you, Chris. I appreciate that. Melissa, is there any other questions? Okay.
There is not, but I just want to let everyone know if they do have questions, you can get a hold of Chris or Keith or Ryan or even myself, and we'll get those questions answered for you.
Thank you. All right, let's go to the prize wheel or whatever it is you spin there.
All right, so now it is time for our prizes. We'll be giving away 3 Snappy gift cards, 1 for $100 and 2 for $50 each. So I have a wheel with all of our attendees' names, so I'm going to go ahead and spin. And our first winner is Scott Melly.
Is that the $50 or $100?
Yep, yeah, sorry. Yeah, that was a 50.
Okay.
And then our second $50 winner is Laura Litter. And finally, our third winner for the $100 is Will Everett. So all winners, just keep an eye on your email and you'll be getting an email from Snappy where you can choose your gift for the $50 or $100. So congrats to all of you.
Thank you, Kendall. Thank you. And just in closing, on behalf of the Eric Ryan Corporation and our speakers today, I do want to say thank you for attending. I guess the only point I want to make today is, whether you choose Eric Ryan, whether you choose another company, don't go at it alone. There's a lot of moving parts to this. You've got businesses to run, you've got decisions to make that are outside of this. And I'm sure we would be happy to help as well as any other consultant, but feel free to reach out to us if there's anything we can provide or do in the future for you. So on behalf of the speakers and everyone that's attended, thank you. And hopefully we'll look forward to following up and seeing if there's anything we can do to help. Thank you, everybody.